Mortgage rates moved higher again this week, and most buyers are blaming the wrong headline. The Feds held, jobless claims came out, and oil jumped. The real reason rates stay high this week comes down to inflation pressure, elevated bond yields, and a market that is still not ready to give buyers relief. I'm Cathy Sabater, and this is your Thursday Market Watch. The biggest force this week was oil-driven inflation fear. As conflict involving Iran kept energy markets on edge, oil prices climbed sharply. And that matters because higher energy prices can keep inflation hotter for longer. When inflation fear rises, bond yields usually rise too. When the yield rises, the mortgage pricing usually gets worse. Reuters reported oil has surged more than 30% since last February, and Freddie Mac's average 30-year fixed rate rose to 6.38% this week from 6.22 last Thursday. So even though a lot of buyers are looking at housing headlines, the real pressure this week started outside of housing. A lot of people hear the Feds held rates steady and assume that should keep mortgage rates, but not necessarily. What matters is the message underneath it. This week, the Fed kept rates unchanged. Policymakers still facing elevated inflation uncertainty tied to the Middle East and seeing limited room for cuts this year. That is not the kind of setup that gives the bond market confidence that mortgage rates are about to improve. Mortgage rates move more on future expectations than on headlines. Right now, the market is still hearing inflation risk is alive. Cuts may come slowly and relief is not guaranteed. But we did get today's jobless claims that came in at 210K, up from 205K last week. Weak enough to calm the bond market. At the same time, the 10-year Treasury climbed up to 4.376 per day, and that's adding more pressure to mortgage rates and making relief harder for buyers to get. This is the part buyers need to understand. Mixed economic data does not automatically improve mortgage rates. If yields stay up, mortgage money usually stays expensive. Compared to Thursday, mortgage rates are clearly trending up. Freddie Mac's fixed average was up from 6.22% to 6.38. That is the highest level in more than 6 months. So let's take a $700,000 loan amount. It's a roughly $73 monthly difference from last Thursday, and that's a potential purchase loss of about $11,700 in purchase power. That is why buyers cannot afford to treat these updates like noise. For buyers, this week is a reminder that affordability can worsen quicker even when the headlines look mixed. That does not mean panic. It means know your payment range. Know your walkaway number. If you are shopping this weekend, pay close attention to homes that have been sitting a little longer because rising rates can make sellers more open to negotiation, even when the market has not fully rolled over. For sellers, this is not the market to overprice. When rates move up higher, buyer affordability tightens. That usually means more sensitivity around monthly payments, more negotiation, and more attention to credit, repairs, and overall value. Serious homes are still selling. Buyers are just doing more math now, and that changes how aggressive you can be. The buy to sell and move up buyer, this is probably the most strategic category right now. If you're selling one home and buying another, rising rates may pressure your next payment. But market normalization may improve your leverage on the purchase side. That means lease back, seller credits, recast strategies, and coordinated timing matters more than ever. The move up decision is no longer about your current equity. It's about how well you can structure both sides of the move. Is the market balancing? More like normalization than chaos. Rates are higher, buyers are more payment sensitive, and the market is becoming more selective. That does not mean a crash. It means pricing, preparation, and negotiation matters more. And for disciplined buyers, this normalization can create opportunity. My advice this weekend is very simple. Do not shop by the headline. Shop by your payment, leverage, and strategy. If you are buying, know exactly what today's environment does to your monthly payment before you fall in love with a house. If you are selling, prices for today, they're not last year's market. If you're trying to buy and sell at the same time, run both sides together before you make your next move. If you want help figuring out this week's move means for your buying power or your listing strategy or your move up plan, reach out. In this market structure matters more than noise.